Welcome back, dear learners. Before the ad break, we spoke about the statement of comprehensive income. And I did promise you that we're going to do some adjustments. And with us here, we have a number of adjustments. We want to look at how do they affect the statement of comprehensive income. Some of them will affect our statement of financial position. So for some, we will create some notes that goes to the statement of financial position. So the first adjustment that we have reads as follows. We have an extract, so this is only an extract, pre-adjustment trial balance of Bush stores on the end of the financial period, which is on 28 February. Now, in our list of balances, we have our trading stock. We have, in the nominal account section, our sales, cost of sales, and debtors allowances. Now, the adjustment reads, number one, the owner took goods at cost price for personal use, very important, 1,200. No entry has been made in the books. When the owner takes goods for personal use, we call that drawings. Obviously, you know that by now, that when the owner takes goods for personal use, it is called drawings. These drawings do not directly affect our statement of comprehensive income, but we have to record them because they will affect what we call trading stock surplus and trading stock deficit. So we don't ignore it because drawings don't go directly into the statement of comprehensive income, but we should record these ones. And the way we record it is we record it in what is called note number 4, inventory. So we're going to record this in note number 4. And very important that when we record drawings, we always record them at the cost price. So drawings must be recorded at the cost price. So we will now come, and here we will now say in our note number 4, we'll come and say trading stock. We have our trading stock here. Who open brackets, and our trading stock is 133,400. 133,400. Then the owner took goods at cost price for personal use. So these goods must be recorded because they say no entry has been made in the books. So we don't have that stock anymore. So I'll come here and say minus 1,200. You will see what I have done here. I have recorded this in note number 4. Note in the statement of comprehensive income. It does not go there. Your drawings are not to be recorded in the statement of comprehensive income. However, they will affect the statement of comprehensive income when we calculate what is known as trading stock surplus and trading stock deficit. So I want you to keep following me, and I'll show you how we will do that. So this is what I have already done. This is how it looks, okay? I want us now to go to adjustment number 2. Let's see what adjustment number 2 will say. Debtors allowances. It reads, a dissatisfied customer, T. Roberts, returned stock with a selling price of 1,960. So this debtor is returning stock with a selling price of 1,960. The markup on these goods is 100% on cost. So we're given the markup, which is 100% on cost, and no entry was made. What we have to do, we have to remember that when a customer returns goods, to summarize it, it will affect 4 accounts. 4 accounts will be affected, which I will call the diskette. I will say diskette. So 4 accounts will be affected. That is your debtors control, that is the D. The S stands for your sales. We're going to adjust our sales. The C stands for your cost of sales, and the T is for the trading stock. Then the question then is, how much affects your debtors control and your sales? It is the selling price of 1,960. And how much affect our cost of sales and trading stock? We will need the cost, which is 100, and we're told that markup is 100, so here our selling price becomes 200. Multiply this by 1,960. When we punch that in the calculator, we will then get 980. 980 now becomes the cost. So at the bottom here, it will be 980. So the first two accounts, that is my debtors control, we're talking note number 5, trade and other receivables. Sales, statement of comprehensive income. Cost of sales, statement of comprehensive income. And then this trading stock is note number 4. Remember, we have done something already to note number 4. So we want to now go and make these adjustments. So remember, it will affect in 4 places. And then we have to know when we get there, are we adding it or subtracting it? Once we are dealing with an allowance, when we go to our debtors, it will be minus. When we go to the sales, it will be minus. When we go to cost of sales, it will be minus. When we go to trading stock, it will be a plus. Now, let us go and do that. So we'll come here, and as you can see now, in my sales, I took my sales amount, which is 1,170,000, which is this one. Then first of all, I subtract my debtors allowances, which is 4,000. I subtract that one. And then I remember that I have a dissatisfied customer, which has returned goods. If I remind you again, we did the discount, and we said it's going to be minus, 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 and plus. Here it's 1,960, and here it's going to be 980. So I'll come first to my sales. There it is, minus 1,960. And then the second place I will make an adjustment is on my cost of sales, where I'll come and say minus 980. On my cost of sales, I'll come and I'll subtract 980. Then the next place I will go is in my note number 4, that is inventory. Remember, we had 133.4, which is this one. And we adjusted adjustment number 1, which had to do with goods taken by the owner for personal use. Drawings, we subtracted it. Now, another customer has returned goods, so we'll come and add to our inventory. So our trading stock becomes a plus. So we have made these 3 recordings so far. Then the last one comes to note number 5, which is trade and other receivables. In our receivables, we come to our debtors control. We have 118,800. Then we say a debtor has returned goods. So we come and we subtract it, as you can see. This is how you would record when a customer returns stock. You have to record it in how many places? 4 places. So we will say discount, debtors control, sales, cost of sales, and trading stock. That is how you would show it in a statement of comprehensive income. Let us see if we have another adjustment. When stock is destroyed in a fire, that must be recorded as well. So we have adjustment number 3, and it reads, a fire in the shop destroyed trading stock costing 8,800. The insurance company will pay only 7,000. The claim will be settled in the new accounting period. All right, let us see how we can record this. So the first place to go and record is in note number 4, because we do not have this stock anymore. It has been destroyed in a fire. We don't have it anymore. Once the stock is destroyed, it is wiser that we come and subtract the full amount. So we come and we subtract the full amount of the stock that was destroyed. But we understand that we will only be covered for 7,000. That is what will only be covered. And that money we are being told that we will receive it in the new accounting period. That therefore means the insurance company owes us. In other words, the amount of money is receivable to the business. So we'll bring it to note number 5, trade and other receivables. Then we'll record insurance claim 7,000. The next place is to now say, if they have covered us for 7,000, yet the stock was for 8,800, who is going to cover the remaining amount? What it simply means is, when we take the 8,800, which was the value of the stock, then we subtract the 7,000, which is what the insurance company will cover. The difference, which is 1,800, becomes our loss. It is our loss. So we then go and record it in the statement of comprehensive income. In the statement of comprehensive income, we record it now as trading stock loss due to fire. So we'll say the 8,800, which is the cost of the stock, minus what the insurance company is covering. Whatever is not covered, therefore, becomes our loss of stock due to fire. Dear learners, let's go for a net break, and I'll see you shortly.